Options trading and standard deviation. Whether you trade stocks or options, you need clues as to where and by how much a stock is likely to move. Analysis requires the use of various technical indicators such as trendlines, relative strength index, RSI, and a number of other commonly used methods that are helpful in predicting a stock's next move, up, down or sideways. But to get an estimate as to the price range of a move, we need to use another mathematical tool, named standard deviation. Keep watching to learn more, but first, please like our video and subscribe to our channel. You might remember the bell-shaped curve from high school math class. This plotted graph resembles the silhouette of a bell, having a camel-like hump in the middle, which thins and flanges out at the left and right side bottom sides. A standard deviation plot shows how data, numbers or items are distributed. Simply put, statistics state that about 68% of the data or items will lie within the area under the curve marked by 1 standard deviation. About 95% will fall within 2 standard deviations. Obviously, at 2 standard deviations, the odds are extremely high. Finally, about 99% will plot within 3 standard deviations. The bell curve shows a normal distribution that occurs naturally most often, and is symmetrical. Half of the data will fall to the right of the center, or mean, line, and the other half will fall to the left. So, standard deviation measures the distribution of a data set relative to its mean. In the field of education, SAT, GRE and other test scores follow the standard deviation pattern. In medicine, where your blood pressure number falls on a bell curve will tell your physician if your pressure falls within the area considered normal. Standard deviation plays an important role in financial markets, especially in trading options. This is because standard deviation shows expected move, that is, a price range in which a stock's price is likely to trade within during a specific period of time. The standard deviation determines the width of the bell curve. Regarding options, implied volatility, or IV, is a representation of one standard deviation move over 1 year. So, a stock's options volatility is used in predicting the expected move of the stock. Take a bell-shaped curve and draw a line down the center, from top to bottom. Draw a line from the top to the bottom a little ways to the left of the center line, and a line to the right. These lines define the area of one standard deviation. Of course, where these lines are actually plotted will depend on volatility. This area represents the area in which there is the probability of a stock's price falling in this area about 68% of the time. To clarify, let's say a stock price is at $100, and the stock has an implied volatility of 20%. 20% of $100 is $20, so in theory, the stock can be expected to move between $80 and $120 about 68% of the time. Knowing the range a stock is likely to move in the short term is especially valuable for options traders who are using spread strategies. This does not tell us if a stock is expected to go up or down, just that it is likely to trade in a given range. Options traders can use spread strategies, such as short iron condors and straddles, to make a profit if a stock stays in a predicted range during the life of the option position. This technique is sometimes used by options traders who try to make money when a company has an upcoming scheduled earnings announcement. When a company's earnings are announced, we never know how the stock market will react to the news. If the report is good, we would think that the stock should go up, but that's not always how the fickle market behaves. Therefore, expected move is quite valuable, because we can set up an option trade that will make money as long as the price stays within a certain range. If we use 1 standard deviation, that's telling us we have a 68% chance of the stock trading in that range after earnings announcements. Of course, if we go out 2 standard deviations, there is about a 95% chance, however, because we'd be taking on less risk and the potential profit from the trade will be much less. The strategy here is that the volatility of a stock goes up before an earnings announcement, because of the uncertainty of what the news will be, and how the stock market will react to it. So, a day or so before the announcement is made, traders will use strategies that sell options, because premiums will be high and they will make more money. Then once the news is out and the uncertainty factor is gone, volatility is crushed. Premiums are now cheaper. So, the trader then buys back the options that were sold, which are now at a cheaper price than he paid for them. Thus, the difference between what he paid for them and the amount he received when initiating the trade is his profit. In low volatility environments, premiums will be low, and the standard deviation range will be narrow. During these times, be sure to keep the size of your trades small to protect your account. You can also try to get bigger premiums by widening the price spread between strike prices.